Welcome back to another video of technical analysis. In this video, we will be talking about indicators. In the last video, I was covering about single candlestick pattern, multiple candlestick pattern, and how to recognize market move. Just looking at by the move of the candles or looking by the patterns that the market is making. In this video, we will be using some of the indicators. So, what advanced traders did in 1900s and 1800s, they developed some kind of patterns in order to trade the markets. So indicators are like just some mathematical calculations that traders used, and in order to optimize their trades, in order to make trades for them. So what I'm talking about is there are two types of indicators. There are leading indicators and there are lagging indicators. So leading indicators tells you that what is going to happen. Like if, for example, the RSI is in overbought zone, so you can just see from the RSI overbought zone that the market can. There's a possibility that the markets can come down. So it is a leading indicator. But a lagging indicators, like for example EMA, like it won't give you it is giving you the indication of the move as the candles are forming. So it is not something that it is not giving you a full pakka surety that in the next candle what is going to happen. But this is the difference between leading indicators and lagging indicators. So technical indicators are tools used by traders to analyze price movements and make trading decisions. So yeah, I was talking about the leading indicators. They signal potential future price movements before they occur. So useful for predicting reversals or new trends. So this was I was giving the example of leading indicators in RSI, that how RSI can predict future. So it is about leading indicators. Lagging indicators signal price movements after they occur. So EMA, SMA are lagging indicators. Next is momentum. So the rate at which the price of a security changes is called momentum. It indicates the strength of a trend. So if the momentum of a particular trend is like it's very bullish or it's very bearish, like yeah, from the MACD indicator, you can just see that like how much of the strength is there into that particular move, up or down move. So that is about momentum, and you have to make sure that you catch the momentum in such a way where there is most volumes. Well, you want a good trade. You want a trade where you can make profits very quickly. The strength of the trade should be very high, and how you will be able to judge the strength of a trade is by momentum. Okay, and next is about it's like section one will cover volume. So what is volumes? So volume is nothing but like for example, there are 1 million traded shares today of BEL. So 1 million is the volume. So what volume is telling that the 1 million buying and selling of share happened in the particular stock, that is BEL. Okay, so volume is nothing but transaction. So volumes helps us confirm the validity of a price movement. So you can see these are the like in trading view, you can see volumes like this. So this you can see it's a low volume, it's a high volume. That means on a particular, on 5 minute time frame or a daily time frame, you can see the volume and you can predict if there is a more volume on a particular day, there is a chance of more momentum. Like there is a harsh momentum that took place if the volume is above the 20 days average. Simple. So it provides insight into markets participants perception, that how many people are actually willing to trade into that particular instrument. If the number of people are more, the strength is going to be more, the momentum is going to be more, and that is the trades, that is the investment opportunities that you have to capture. If there are more people behind any type of up move or down move, there is a possibility that the move itself will be, the strength of that move will be good. What is the trading activity in volume? So it indicates the level of trading activity and liquidity of a stock. Like the more the volume, the more is the liquidity, and higher volume indicates more active trading. So you can see all these FNO stocks, so futures and option stocks. There is like oddly 200 stocks that in NSC. that is registered under futures and options. In why these stocks are registered under futures and options? Because there is more liquidity. The number of participants trading into that particular stock is comparatively very high related to the 5,000 stocks that are listed in the NSE. So all the Nifty 50 companies like are registered in FNO stocks because like these Nifty 50 companies are having massive volumes. Like I'll just take you to an example so that we can understand this better. Just a second. So let me give you an example about a FNO stock and a non-FNO stock. So this is Adani Ports. So you can see the share price of this company is like 1493 rupees. And you can see here the volume is somewhere around 7,33,000. So Adani Ports is a FNO stock and it's included into Nifty 50. And you can see even if this stock is having such a big price, the volume is still greater. And let me talk about a non-FNO stock which is having low volume. So this is Sumitomo Chemical, and you can see even the stock price is around 500 rupees. The volume you can see here is around like 1,71,000 shares. So this is the difference between FNO stock and non-FNO stock. Like FNO stock usually have more volumes. The market capitalization is much bigger. The companies are trusted enough, and that's why you can trade them into options. So let us get back to the topic of understanding volumes, and you can see the volumes. You can see here that volume ka chart pattern, like the volume looks very thin, like the bar of that particular volume looks very thin. And in case of Adani Ports, uh, you can see that like the bar is still thinner, but you can see the volume. There's a huge difference between the volume. It's almost seven times the volumes in Sumitomo Chemical. So understanding volume, let's get back where we were. And for example, if 100 shares are bought and sold, the volume is 100 shares. So this is like the core concept of volume. It won't be 200 shares because the 100 got bought and like the 100 got sold. Like the transaction itself is just 100, so 100 is the volume. So from 9:30 a.m. to 10:30 a.m., 500 shares at 622 someone bought, and additional 800 shares at 624. So the cumulative volume at 10:30 will be like the addition of both of this 500 plus 800. So the volume will be 1300 shares. So the volume trend table, a bullish scenario increases in both. So like you can see if there is a bullish scenario, so increase in both prices and volume indicates that there is a very good chance of that stock or that particular index going up. So it's a perfect bullish scenario, and a bearish scenario is like when the price is increase when the price is just decreasing and there is a like very high increase in volume. So the bar chart of this particular volume pattern is big and the price is dropping sharply, then it's a bearish scenario. If the bar chart is up, then there's an increase in volume and there's an increase in price as well, so there is a bullish scenario. And weak hand caution will be the price changes without corresponding volume changes. So either the volumes are very high and the prices are not deflecting so much, or if the price is deflecting and the volumes are both of them are not giving the clear indication that which type of trend it is, either it is a bullish scenario or a bearish scenario. In that case, you should like volume is not the only indicator that you should depend on. You should look at other indicators when you're setting up the trade. And if there is not a perfect scenario, like where there is not a bullish scenario and bearish scenario, avoid taking that particular trade because it can burn your hand into the trade. So interpreting volume trends. So high volume, that means like today's volume is greater than the 10 days average volume. So how you can interpret that today's high volume or low volume? So by looking at the averages, you can just take the previous 10 days average, and you don't have to take it, like the indicators do it for you. So just to explain the concept, like if the today's volume is greater than the past 10 days ka average, then it is a high volume ka day to day. If the today's volume is less than the 10 days ka average, so by like by a EMA line or something, by a moving average line, you can get the volume of low if it is a 10 days, like high volume day or low volume day. and the average volume is nothing but today's volume should be like, if it is average volume, like the today's volume is equal to the 10 days average. So then it's an average volume day, it's a high volume day, a low volume day. It's three parts. So when this big money comes into picture, there is a more volume into a particular instrument. So a large volume, a massive volume indicates that there is a lot of institutional buying into that particular stock or index. We are talking about stock markets in particular. So the smart money comes with huge volume. Like, they will be like LIC will be buying 5 million shares or something. It will be buying 50 lakh shares of something. So it won't be like, like us 10 stocks or 20 stock or 1,000 stocks. So as soon as these big players come into picture, you can see there's a, big increase in volume, and that's where you have to target your trades. If there is more volume and the price movement is some bearish or bullish into a particular asset, you can just take the trade into that particular direction where there is more volume going in. So increased price with increased volume is institutional buying, and decreased price with increased volume is institutional selling, as I was talking about. So the volume price relationship, as you can see, this is the 10 days moving average, you can see. And on this particular day, the volume crossed the 10 days average, and the next day what we can see is a bullish trend. Just you can just see there's some kind of, it's not hammer actually, the inverted hammer, but you can see after this volume the stock was in continuous downtrend. There's a hammer kind of shape, that is, after the trend, and like it is simply a sign of a reversal. And you're looking at the volume, 10 days volume, and it is today's volume is greater than the 10 days average volume. You can take your trade that, in hope that the market is going to go up, and you can see there's a after that day there's a perfect up move. And again in this, there was no volume, and you can see there's a low volume, like it's not able to cross the average volume also. And after this day, on this particular stock, the volume surpassed the 10 days average, and you can see a huge up move after that coming up. So, like, you need to, align your trade with the indicators in order to get confirmation. That's what the whole point is. So you can rely on multiple indicators, you can rely on simple indicators, one, two indicators, but at the end of the day, volume is one indicator that you should look at, because like it does matter how many people are participating into a move. So if the number of people are, if the number of people are significantly high, so you can just see the trend momentum will be very much good, and you can make good profits out of a particular trend. So price increases with decreasing volume will be a potential bull trap due to weak retail participation. So there is a kind of traps also that you can get into. So bullish indicators is increased price and increased volume that I was talking about. Decreased price with volume indicates strong selling interest. And another, when the price increases with decreasing volume. So if in a scenario the price is increasing but the volumes are decreasing, you can see there is a potential bull trap. So the big players are, slowly slowly selling the instrument. And because the, retailers are trying to, buy that particular thing, it is just going slowly up. Imagine a scenario, and as soon as the the retail investors or traders get trapped in, they just sell the instrument, very harshly. So, and another kind of trap is when the price is decreasing with decreasing volume. So you can see there's a potential sell-off by weak retail participants. So, like, potential bull trap due to weak retail participation, and potential sell-off by weak retail participation. When the both the things are not going hand in hand, the resulting volume and the prices are not into, similar direction. So the volume should be increasing even if it is the price is going up or the price is significantly going down. But the volume should not be, very much lower, when the prices is slowly increasing or the price is slowly decreasing, because that will be a potential trap for retailers and traders. So practical application of volume. So always confirm price movements with volume. High volume often indicates institutional participation, and that's what you have to focus on. You have to focus on the big money, where the majority of the participants will be shareholders, which are banks or FIIs or FPIs, foreign portfolio investments or foreign institutional investments. So these kind of moves that you have to try to capture so that you can make money out of it. So avoiding trend, be cautious of price movements without supporting volume. So if you see there's some price momentum happening and the it is not supporting the volumes are not significantly increasing. Avoid these kind of traps. So you can get into a bad trade or a bad investment if the volumes are not increasing significantly, even though prices are going into some kind of direction. So regular monitor volume trends alongside price movements. Section 2, like this is the most used indicator, I would say. So moving average is nothing but it takes into consideration the previous candles. It takes the average of the past. You can just set it in the indicator itself. You can set how many previous candle ka average you want to take into a particular trade. For example, you can take 9 EMA. So on a daily time frame, it will give you an indication of the previous 9 candles ka average. And if today's candle is greater than the previous 9 days ka average of that particular price, you can just go into a buy side. Or if it is less than the previous 9 day ka average, you can go into a sell side. That is how we interpret this particular indicator. A moving average is a statistical calculation, so to analyze data points by creating a series of averages of different subsets, it smooths price data from a trend following indicator. So you know why averaging is important? As you can see, like even the 100 days, 100 EMA or 200 EMA, it tells you a lot about like the market strength and weakness. If a stock is going, below 200 EMA or 100 EMA, so the past 100 candles, the past 100 days, like the today's price is less than, you can just interpret in such a way that the stock was going up from last 100 days, and today like it is not even able to sustain the 100 days ka average. So if it sustains below that particular thing, you can just exit into that particular stock. And if it supports that particular thing, if it supports that 100 EMA or 200 EMA, you can just buy that particular stock, because after that there's a huge gap that can be filled by the particular asset, and there can be a huge up move. So what I'm trying to say, it smoothest price data to form a trend following indicator. So there are two types of moving averages. There is simple moving average, and there is exponential moving average. So simple moving average takes into consideration, it weights all the previous candles, equally. So the last 10 days, it will take, for example, the closing price ka average and the closing price of all the last 10 days without even taking consideration the weights of it. So what I'm trying to say is that it is considering every past 10 days equally. So even if yesterday was more important than 9 days before, it is not taking that into consideration. So that's why it's called simple moving average. It's calculated by summing up the closing price of a stock for a certain period and dividing by number of period. It helps identify the direction of the trend. SMA is a lagging indicator and reacts slower to price changes. As I was telling before, so moving average is nothing but lagging indicator. It won't give you any prediction about the future, but what it can show you is how the prices, like it reacts slower to price changes. Like you won't be able to see the future with the help of indicator, but you can, at least see how that particular asset is reacting according to the prices. So exponential moving average weights it. So yesterday, for example, I'm taking 10 days EMA. So I am taking consideration the average of the last 10 days. But in weighted format. So how weighted format? So I'm considering yesterday as the most important, day before like little less important compared to yesterday, and so forth and so on. So like I'm considering the least important, the 10th day, like the from 10 days before from today, and so it gives weightage according to the days it's passing. So yesterday is more important, the yesterday's price movement is more important for me than day before, and so forth. So it takes into consideration, and as the market moves, so it takes into consideration accordingly. So actually EMA is better than SMA, I would say, because it is considering weighted, or it is considering weighted average first of all, and weighted average is much more of an important thing rather than taking a simple average, honestly. And it used to generate buy and sell signal based on crossovers. So what I'm trying to tell, so there are two type of. Now I'm showing you about the golden cross and the death cross. So you can see this is 50 days moving average. Okay, and this line is 200 days moving average. So if the 50-day moving average crosses above the 200 days moving average, then it is considered to be a bullish sign, because the last 50 days ka average is greater than the last 200 days ka average, which means you can just simply, by logical reasoning, you can just understand it. Okay, the price momentum is taking place in such a way that the last 50 candles are pushing the market upwards if you are comparing it to the 200 days of market trend. So this is called a golden crossover, and you can decide to take a trade as soon as it crosses over the 200 day moving average, and at the closing of any of these bars, you would have taken a trade, and you can see after this particular there is a significant up move that went up. So it can be around, the price went up from 120 to somewhere around 122. So like without even taking consideration into any of the other indicators, just looking at the golden cross, you can decide to enter into a particular trade. Opposite to it is a death crossover. So imagine, the price momentum is happening in such a place, in such a way that the last 50 days ka moving average, is closing below the 200 days ka moving average. So there was some kind of 200 days ka moving average, but the last 50 days were that bad for that particular instrument that the average of that last 50 candle is closing below the 200 days EMA. So it signifies you there's a bearish trend, and as soon as it crosses over, it's called the death cross. You can take a trade about on selling a particular instrument, and you can make a good profit out of this. So using moving average for trading. So actually most of the traders rely on moving average. So people have different kinds of moving average ka numbers. Some takes into consideration 200, 50, 100. The people that are like who are intraday traders or swing traders, like who wants to earn money quickly into the from the markets. They're holding a trade for 1 week or something. They'll take into consideration 9 EMA, 21 EMA. So these are some of the useful EMAs that people take into consideration. There are people who take 10 and 21. There are people who take 9 and 15 also. I've seen. So actually, it depends upon your setup. So how you see the markets is what I'm trying to say. So they will define which particular moving averages you will take. I'll take an example. Just remove this volume. I will take EMA. So here you can see I'm taking 9 EMA, and here I'll just set a 15 ka EMA. So looking at the EMA right now, like I'll just color it. looking at the daily time frame, and you can see, the price supports most of these moving averages. The 9 moving average is, super duper important. And you can see, like, today's low price was just the 9 days ka moving average. As you can see, it is taking multiple supports. Like, there are a lot of wicks, there are a lot of, shadows into this particular stock. But as soon as, yeah, that can be a trade, that as soon as it touches a 9 moving in an uptrend, as soon as it is touching 9 days ka moving average, you can take a buy trade if it is not closing below the 9 EMA. So you can see the closing of this particular candle, the yesterday's candle, the day before, the candle is still, the closing is above the 9 days moving average. So the past 9 days average is less than what is today ka price is. That is what it's trying to justify. So you can see, as soon as it crosses over, so I'll just show you. So here you can see, as soon as the 9 EMA crossed the 15 EMA candle, so the 15 EMA was greater, and from at this point the 9 EMA price crossed the 15 EMA, and from that day you can, you would have, if you would have bought the Adani stock, Adani Enterprises, the Adani Ports ka stock, without, you would have made 10% profit in like 8 days. That is the kind of move that you can capture using moving averages alone. Moving average works very good, honestly, and like, yeah, some people takes into consideration 921 as well. So I'll just stick on to a 5 minute particular time frame, and let's see what trade we can get. So at this particular price, yeah, you can see the it is taking support at 9 EMA, and you can see the stock actually is moving up. Take a long position. You can actually set your stop loss, just below these EMAs, and with very small stop losses, you can actually make a good profit out of these trades. So if it breaks this kind of resistance, a 5 minute resistance, the stock can go to here, the last swing. Yeah, so the risk reward for this particular trade, the target is 3 rupees. And actually it's going into a bullish side. So actually this is the last one. I'll just take on a daily. Uh, you can see the stock is going up into real time. So what I analyzed in this particular thing is the 9 days moving average. Okay, okay. So TP, you can just see, the take profit. It just took 5 rupees take profit in front of me, and with a stop loss of this small. So that's how, you can just see that it took support at 9 EMA, and the move was significantly much higher. Okay. Still, and you can see the volumes also, how it is supporting. Whatever we just understood, we are applying right now, that 10 days, the previous five minutes key 10 candles, the volume is above the last 10 daily 10 5 minutes candle, and as soon as it, all this setup took place, and you can make a trade. That's what I was trying to say. So let's get back. So Adani Ports, just rose 5 rupees from here. Then let's get back to, so now, and what are the entry and exit points, as I was talking about earlier. Sorry. So I was giving you about the, just a second. Yeah. Yes. So okay, it hit the target. Uh, Actually, it went up. So yeah, you can take intraday position. You can do FNO as well into this particular stock. What I was talking about, the entry and exit position. So that my entry position, was somewhere around here. As soon as, the closing of this 5 minutes was above the 9 EMA, and my stop loss. So I would have, cut my losses if the trade would have gone somewhere around here, like just below the 21 EMA. 21 EMA. So you can, set stop loss entry and exit points using EMA. So a crossover of like a smaller time frame crossover above the larger time frame signifies a up move, and the otherwise smaller time frame like the 9 EMA, which crosses below the 21 EMA or a larger time frame, will help us in identifying there's a short move. So in this particular scenario, you can see the 21 moving average now is greater than the 9 days ka EMA. So you can see after this, there's a huge selling that took place into, like, I think it's a good percentage move. Yeah. Half a percentage in a day is a good move, like in just 5 minutes candle. So that's how you analyze, and what will be your exit position in this particular short trade. So your exit position would be somewhere around just above the EMA. So you want to cut your losses as soon as the market is going up. So if you are thinking that the markets are going to go down, you are selling this particular stock. If the otherwise happens, you can just with a very small stop losses just above the just above the moving averages of 21, 9 and 21, you can put your small stop loss. So at a 1 rupee stop loss, you would have taken a 6 rupees ka target, which is like a risk to reward of 6. And in the previous videos, I was talking about the risk and reward should be at least 2, at least 2 or 1.5. So you should not take trades if the risk to reward is 1 is to 1, because if you are willing to sacrifice 1 rupees to earn 1 rupees, because that won't fill the equation. If you are sacrificing 1 rupee on a gain of 2 rupees, then it makes much more sense, or more than that. You can take up to risk reward as high as you want, but you should not take risk reward which the ratio should not be less than 1, less than 1.5, because like the amount of risk that you are putting into a trade is not justifiable. So there's no use of taking that much risk, to be very honest. So yeah, it went full up and then it went down. Limitations of moving average. Moving average are lagging indicators and may give delayed signals. So, and MA can give false signals during sideways or choppy markets. So, for example, if the markets are consolidating, and you can see the crossover of 921 or 915 or 100 200, so this can give you a false signal, because the markets are into sideways. So there is kind of trend, there is uptrend, there is downtrend, and there is a consolidation phase. Consolidation phase is something which the price is moving in a range and it's not able to break a range. So in these particular scenario, try to avoid taking trades. That's what my full focus is on. I did that mistake when I was young, when I was early into this particular field, but I don't want you guys to take you guys to do the same. For example, what I'm trying to talk about is, you can see this is a consolidation phase, full consolidation phase. There's no up move there's in this particular time frame. There's no up move, there's no down move. The market is going into a range. The stock is going into a range. If it breaks a range, then you can take a trade. But getting into consolidation market, especially in options, will eat up your premium. It won't give you any money, and at the end of the day, even the move is into your side. If the markets are slowly consolidating and going into a particular side, it won't help you. Next, moving average, convergence, divergence. So it's one of the popular indicator that we use in order to analyze the markets. MACD, what MACD helps, like it do some kind of calculation, and some kind of calculation it takes into consideration three kinds of MA. So again, it is a moving average, but the moving average takes the moving average indication is in such a way that it gives you a clear indication that where the market is going to head up upon. So consists of MACD line, signal line, and histogram. It helps identify change in the strength direction, momentum, and duration of a strength. So you can see there's a lot of thing that this is trying to explain. Just looking at the, just looking at the MACD indicator, you can see the where the market is going to head on. So you can see the line, the these two crossovers. The violet line crosses the gray line crosses above the violet line, and you can see from here there is a bullish sign. So the histogram, the small histogram, is greater than zero. So this is a zero line. Okay. So if it crosses above this and the histograms are greater than zero, there's a uptrend. There's full uptrend into the market. And if this is called bearish and this is called bullish crossover, and if the gray line, as you can see, the gray line crosses below the violet line, then it is a bearish crossover. You can see the histograms going down red, and after this you can see start of a bearish run. So after this it went significantly down. So that's how you use MACD. Again, let me go back to the uh, chart pattern. Now I'll analyze some. Sorry. So this is also into a, I'll just take into consideration some different stocks so that yeah. So just go into chart patterns. So you don't need to change any kind of setting for this. You can just directly go on to, you can see the MACD on a daily time frame to know where it is heading, and you can see the histograms are greater than zero, and the blue line crosses above the orange line, and after this point you can see a huge movement upside on this particular Zomato stock. So after this it gave roughly around a move of 26 percentage. That's huge, honestly. So just looking at the crossovers, you can just identify if the stock is going to go up or if the stock is going to go down. Same with the index as well. If the Nifty 50, Bank Nifty, Fin Nifty is going to go up or down. So you can try to define your trading system. In the later part, I'll try to help you in defining your trading system. There are a couple of indicators. There are a couple of candlestick chart patterns. There are multiple candlestick chart pattern. There is single candlestick chart pattern. So your whatever trade analysis or investment analysis based on technicals should be confirmed with different indicators. So you can use EMA, you can use volume, you can use RSI, and if two three indicators are telling you the same kind of story that what is going to happen, then you don't have to worry about what will be the outcome of your trade, because many of the indicators are telling you the same story that what is going to happen, what can be the possibility for a particular thing. Then you should not look on to what, like, if this particular thing is going to happen or not. So that's how you have to make your decisions in a more constructive way using indicators. So MACD gives you perfect indications if the histograms crosses above zero. So this is the threshold zero, and if the blue line crosses above the orange line, it gives you a clear indication that the stock or a particular index is going to go up. And if the otherwise crossover happens, and you can see the market went down eventually. So that's how you look at, and justify your trades with the help of indicators. Next is, so the difference between the MACD line and the signal line indicates the momentum, as I was telling you about the momentum. So, it gives you a very perfect indication. Like MACD, in a bullish crossover, the MACD line crosses above the signal line, indicating a buying signal. Conversely, a bearish signal crossovers indicates a sell signal. So if the from the up it crosses over, so the move is going to go down. If in the below it is crossing over like this, and the histograms are greater than zero, it will be a bullish signal. So what is RSI? So RSI is relative strength index. So it takes average. The calculation takes place in such a way the buying momentum is divided by the average buying momentum is divided by the selling average momentum, and it gives you a line like this. So you can see there's a range from 0 to 100, and you can see there are two lines, 30 and 70, and it signifies overbought or oversold zone. So what I'm trying to tell, if a particular stock or index is into overbought position, so that means the number of buyers, they have overbought this particular asset. So what happens when something is overbought? It gets sold easily, right? And same happens when there's something happens called oversold. So if something is oversold, it should not the selling took place so sharply that the price momentum happens in such a way that the particular stock may be undervalued. You can just see undervalued or overvalued defined by RSI. So the default setting of the RSI is 14. Like it takes 14 previous 14 candles ka average. An oscillator that measures the speed and changes of price movement ranges from 0 to 100, with levels above 70 indicating overbought and conditions below 30 indicates oversold. So actually, this RSI divergence occurs when the price moves in the opposite direction. So actually, it gives you a reversal trend ka signal. Failure swings. So RSI can signal reversal when it fails to reach a new high or low, despite the price making new highs or new lows. In an uptrend, if the RSI moves up above 70, then drops below 70, it might indicate a potential reversal. Same if the in a down move, if the RSI moves below 30, and after, like, again it is coming back above 30, you can see there's a potential reversal, and there can be a huge up move. So it happens both the ways. Again I'll take an example to clarify what I'm trying to tell. So these are very important indicators what I'm trying to cover. Don't bore yourself that what am I teaching. So moving averages are very important. RSI is very important. MACD is very important. Volume is very important. So you need to confirm. For example, you need to make your system in such a way, your trading system or your investment systems in such a way that your whatever intuitions, like, okay, this stock is going to go up or this stock is going to go down, it should be confirmed with the help of indicators. That's what this whole process is all about. So again, I'll try to take RSI and then I'll show you how this particular thing works. So this is Zomato. Again, I'll just go into RSI. Actually, like, according to your comfortability, you can choose your indicators, and you can see, I'll just set a threshold to above 70, because that's what my trading system tells, that something the RSI takes into consideration 80 and 20. So if it is above 80, then it is overbought. If it is below 20, then it is oversold. So I'll just change the settings. Give me a minute. You can see the volumes are today's volume is also not greater than the 10 days cover. Again, one more indicator that we are going to attach into this. That's that's what you can use a series of indicators in order to justify your trades, in order to justify. So in the Bollinger Bands, you can see that today's candle is breaking up the upper band. What did we just learn in the Bollinger Band series? As soon as it breaks the upper band, you can take a sell trade, and you can see from the RSI it is into an overbought zone, and from this the volumes are not supporting us, to be honest. The volumes are not supporting us. So if it is, like, it is at the average, so it is just the average volume of the last 10 days. It is not above the average. So And what we saw into that particular section, like we can, we can get into some kind of trap if the volume is not supporting it. So this is an upward move, and the RSI is showing us that it can be, the stock can fall. The Bollinger Band is showing that the stock can fall. Obviously, a risky trader will take a trade of a sell position, but a trader who is into a prop like he's adopting a strategy where he's taking into consideration the volume as well. What you should take into consideration, he will definitely look into the volumes which is above the 10 days ka average volume. So in order to, justify that this stock is going to go down, you need to make sure that the volumes are also aligning with your particular trading setup. So that's how that. So I think you got, I think I was very clear about the Bollinger Bands, that how exactly to work out with all the, as soon as it touches or it crosses, below the lower band, you can just take a buy. As soon as it crosses over, here it got failed. You can see again, it crossed above, it didn't come down, like it came down very, like it's not very proportionally. The risk reward, doesn't make any sense taking a trade. So, and but at this point actually it came down significantly. It broke the upper band, it came down. Now again it's trying to break the upper band. Let's see if it, so the next candle will show us, if it is a red candle and it closes below this, then we'll get a confirmation from Bollinger Bands that okay, this stock is going to go down. So that is about Bollinger Band. So in this today's episode of trading analysis, technical analysis, we saw that, like, what are the indicators that you should use in order to make your decisions, in order to make your trading decisions very wisely. So you can use a combination of indicators. You can use one indicator alone. You can master one, two indicators, and continuously looking at some of the patterns. You make a pattern of yours. Like, okay, if the RSI is above 40, or it crosses above 60, then it is an overbought zone for me. Like how I made it for myself, that if it is above 80, then it is an overbought zone for myself. So the RSI is still not aligning in the case of Zomato, that it is into overbought zone. So that's how you can make a setup of yours, and then you can practically trade on your setup. Actually, I'll help you in figuring out that one of the strategies that I was telling about you is 915 strategy. The 915 EMA, you have to use it with the combination of volume. You have to use it with a combination of, Bollinger Bands, so forth and so on. You make a system for yourself. This is purely an art. This is nothing science, because it is not universal. Every time the indicators tell you something, it's not that the thing is going to happen. But what is possible, it is only a possibility. The probability is higher, but it's not a 100% confirmation. The 100% confirmation comes into your intuitions. So that's why trading is an art. That's what I think. It's not a science exactly. Even if it is a science, it comes with art. So the practical tips: choose indicators that complement each other. So the RSI complements with the moving averages, or the Bollinger Bands, complements with RSI. So they are taking into consideration moving averages. You can take combination of volume and moving average, volume and RSI, volume and Bollinger Bands to make your trades very much, and with the candlestick patterns. Don't forget, first thing you have to check about is candlestick pattern. Second, you have to look at all these indicators. Then you have to see if all of these system is aligning. Like four, five, there are four, five rules, and if you are able to checklist four out of five, you can take a trade. If if you are able to check in only two out of five, then you should leave it. That's how you have to make a very constructive approach towards trading into market. Last is Fibonacci retracement. So Fibonacci, if I'll talk about everything in this world, even the phase structure of Earth, or how this cyclone happens, everything is calculated. This Fibonacci pattern and everything. What is Fibonacci pattern? So 0 plus 1 is 1. Okay, 1 plus 1 is 2. 2 plus 1 is 3, 3 plus 2 is 5, 5 plus 3 is 8. So actually this series itself is very important, and so forth and so on. So if you take into, if you divide all these terms, this clear pattern, there's some kind of, very constructive pattern. The ratio of any number to its next is it's an appropriately 1.618, known as the golden ratio. The ratio of any number to its next. So 5 divided by 3 is approximately 1.6. 8 divided by 5 is approximately 1.6. So how this series is, like, it's so beautiful series, and actually it is not, it is into flowers. Like, you can, by the shape of flowers, you can see, there's some kind of Fibonacci sequences there. So that was just about Fibonacci. Now we can use the Fibonacci indicator into stock markets, and actually it works very, very good. So the commonly used ratio in the Fibonacci is 61 percentage, 38 percentage, or and 23 percentage. So it applied to stock charts for identifying potential retracements levels, and stock tend to retrace before continuing in the direction of the trend. So I'll just show you with the help of an example. So this was, how you can use Fibonacci retracements, and actually it works very well, to be very honest. Uh, you can just mark the high and low, the high and low on Fibonacci retracement, and you can see there's some kind of numbers written there. So according to, you should look at these particular three percentages: 61 percentages, 38, and 23. So you can see, like, this stock was an up move, and it came down. It was consolidating around 38 percentage wala Fibonacci retracement, and you can see after this it gave an up move. So it takes support on 38 percentage. It takes support on 61 percentage. It takes support on 23 percentage. It can come down. It can be a level of support. It can be a level of resistance. So you have to use it, like, this indicators works very well into markets, because I told you there is some kind of Fibonacci ka, pattern into everything what we are living. I don't know how, but it is the reality. So into the stock market, so you can use this indicator very wisely in a downtrend. This take so as soon as it retraces at a 61 percentage, it gets, so in an up move, the up move, it takes support, and in the down move it takes resistance. So resistance means, like, after, as soon as it touches at 61%, it's going to come down. In an up move, as soon as it touches 36% or the 61 percentage, it's going to go up. So in an upward direction, it is taking a support. In a downward direction, it is taking a resistance. As soon as it will touch at this level, it will come down. That's how you can use this indicator. So now I'll show you a live example of Fibonacci retracement. Uh, so this is Adani Ports. So in order to, analyze a stock or index based on Fibonacci, you need to capture the two swings, the lower swing and the higher swing. So you can identify, the high and low of a particular asset. So yeah, this is high and low, the recent low and recent high. So you can see at this particular level, so the 21 percentage level, it can take a support at this level. In an up move, upward trend, it takes support into 21. It takes support at 61 percentage, and one more percentage we saw. It takes at a percentage. I'll just refer 38. Yeah, 38, 61, and 23. So 31. So, somewhere around here also it can take a support, 21 and 61. So these are the levels of support in an uptrend. So yeah, now you know that how to use this Fibonacci retracement. You can use it from here in a light blue. And considering a downward, let's assume a stock which is into downward direction. A downward direction stock will be AU Bank. Yeah. So from high, we can connect the low of this EU bank, and it takes resistance. If you remember, it takes resistance at all these percentages. So you can see, this was the high, this was the low, and it is on a actually 5 minute time frame. I'll just switch to 1 day time frame to get a clear picture, and I'll just remove this Chotusa Fibonacci. Yes, okay, and Fibonacci, and this is the high. And because of the bad quarter results, or the stable growth, there was no up growth. Again, it is coming at this 21 percentage level, you can see, and in a downward move you can see the stock has reversed from, it was in an upward trend, now it is in a downward trend. So this can take, at this, today it took a rejection at 21 percentage level. So now here it can take a resistance at this level, and again it can go down. If it or otherwise it can take resistance at 31 percentage level or 61 percentage level. So that's how you can analyze stock with the help of Fibonacci retracement. And most of the time it works exactly the same. And that's it from my side in this today's technical analysis video. What we saw, how to use indicators in order to make your own trading system. You have to rely on specific indicators up to your choice. You can use a combination of 2 3 indicators. You can use candlestick pattern in order to confirm a particular move, but all of this depends upon your trading system, your trading psychology. Are you an intraday trader, or you are a swing trader, or you are a long-term trader, long-term investor? So, what helps you in identifying the investing and trading opportunities? You can use these indicators in order to make better financial decisions. And that is all from my side. Thanks for watching. And in this particular video part, we have covered, almost the technical analysis aspect of full stock. Next, we are moving forward with the fundamentals, and making your own systems. In the later videos, we'll delve into futures and options, quantitative development, how we use strategies, how we can use algorithms in order to make trading decisions, investing decisions, and so forth and so on. Thanks for watching. Stay tuned, and there are some good content coming up.